The housing market has been absolutely insane over the last couple of years. In 2021, we saw the price of homes in the US rise by an average of almost 19%. That's the largest year-over-year increase since they started tracking that data 35 years ago. But now, the market has completely flipped. In March of 2023, home prices had a year-over-year drop of 3.3%, the largest drop in over a decade. Why did it change so fast? At the start of the pandemic, the world went on lockdown. This caused a large portion of the workforce to start working remotely, and even those who were laid off started spending more time at home. It also meant a lot of people had nothing to spend their money on, so they saved it in record amounts. With all that time at home, no commute, and some extra cash, a lot of people wanted a change of scenery, so they moved. With interest rates near zero, it seemed like the obvious choice. This led to tons of demand for housing, which drastically drove up the price. Now the situation is basically the opposite. In March of 2022, the Federal Reserve started raising interest rates to combat rising inflation, and they haven't stopped since. With the federal funds rate now above 4.75%, it has made buying a home much more expensive. In January of 2022, the average 30-year mortgage interest rate was 3.45%, meaning if you financed a $400,000 home with a 20% down payment, your monthly mortgage payment would be $1,428. In March of 2023, the average interest rate has gone all the way up to 6.54%. That means financing that same home would cost you $2,031 a month, an increase of over $600. Money a lot of people just can't afford to put towards housing. Sure, housing prices have gone down around 3% on average across the US, but monthly payments have increased by over 40%, making homeownership even more unaffordable than it already was. This has kept many people out of the housing market who would like to move, but if they sell their homes now, they will be sacrificing a very low interest rate for the highest mortgage interest rates they have seen in over a decade. Redfin even shows that new home listings have fallen by 23% over the last year and are at their lowest point in over a decade, excluding the onset of the pandemic, of course. This also means that many potential non-homeowner buyers are opting to rent or live with family longer, which is reasonable considering that high interest rates have actually made it cheaper right now to rent rather than buy in most of the United States. I think a lot of buyers are hoping that either prices or interest rates will go down in the near future so that they can get a better deal. These factors have led home sales in the United States to absolutely plummet over the last year. The one saving grace for the housing market is that the supply of homes is extremely low. A balanced market will have a supply of roughly 5 to 6 months. Our current market only has a supply of 2.6 months, which makes this a seller's market. So even though a lot of people are deciding not to purchase homes right now, the few that do are fighting over a small number of them. This is great news for homeowners because if the supply was higher, we could see home prices decline much more than they already have. It's also important to note that the housing market is drastically different depending on where you live. In Boise, Idaho, housing prices have fallen by over 15% in the last year, while in other parts of the country, home prices have actually risen. There are also some other extremely concerning indicators. For the first time since 2008, mortgage lenders are actually losing money for every loan that they originate. In 2021, they were making an average of over $2,300 per loan, but in 2022, they lost an average of around $300. It doesn't take a genius to realize that losing money is not good for a for-profit business. So why are they losing money? Demand decreased for mortgages so much and so quickly that lenders couldn't downsize fast enough. This meant their costs were drastically outweighing the money they had coming in. We've also seen that after the fall of Silicon Valley and Signature Bank, fear has spread throughout the banking industry. Many regional banks are afraid that they could suffer the same fate. This has led many banks to substantially tighten their lending requirements as a way to reduce their exposure to risk and avoid potential losses. This is known as a credit crunch and can be very bad when many companies rely on cheap, easy-to-access loans. This credit crunch also has the potential to worsen an already happening commercial real estate crisis. With the pandemic moving everyone to remote work, companies don't need as much office space as they used to. This means that there are a lot fewer renters for large commercial real estate buildings, especially those downtown and city centers. On top of that, the high interest rates are having the same effect on commercial real estate owners that they are having on the average American household. This could lead many of the maturing commercial real estate mortgages to be defaulted on, devaluing commercial real estate. Morgan Stanley even says that they think we could see commercial property prices fall by as much as 40%, which is similar to the decline during the 2008 financial crisis. There's a lot going on in the real estate market right now, to say the least, and most of it is extremely concerning. So what happens next? With a commercial real estate crisis looming, we could see a big downturn in its value. There have been a lot of ideas thrown around about how to revive and renovate all these nearly empty office spaces. The most prominent idea has been to convert them into other types of spaces, primarily residential. Seems like a good fit. A lot of these spaces are in busy downtown areas where rents are through the roof. Providing more housing could help to meet that demand, but converting office space into residential space is a lot easier said than done. Either way, I don't think that many people are going to be returning to the office anytime soon. soon, so they are going to need to find a use for all of that space. As for the housing market, the weakness isn't going to end overnight. Even as we move into the summer months, which is traditionally a strong time for the market, things are still very weak. On top of that, the Federal Reserve could still raise interest rates even higher, but even if they decide not to, Jerome Powell has publicly stated that they don't plan to do any rate cuts in 2023. This means the pressure that higher interest rates put on the housing market is likely going to remain throughout the year. All that being said, where exactly the housing market goes from here isn't certain. Some economists see things recovering from this point forward, while others have more negative outlooks. Economist Robert Shiller, who predicted both the 2001 dot-com bubble and the 2008 housing bubble, has predicted that we could see housing prices crash by over 10%. He made that prediction back in August of 2022 and still stands by it today, saying that the housing market downturn is likely to continue. The housing market is in one of the weirdest places it has been in a long time, so it's really impossible to guess where it's going. Things definitely seem to be trending in the down direction, but only time will tell where the market is really headed. If you like this video, then check out my video on the recent bank collapses and why Bitcoin was made for moments of instability just like this.